Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, and it's my pleasure today to have Ivy Zelman, CEO of Zelman and Associates. And I would say for all you people that have banks, builders, mortgage people, anybody else really interested in real estate research, you're getting ready to hear the best in the business today. So I hope you'll stay on through the whole interview, because I think you'll find some really interesting things. But Ivy, thanks for coming on.
Thanks for having me. I appreciate it.
So I'll let you kick it off here, and with ever how you want to proceed.
Fantastic. Well, it's an interesting time in this country right now, and it's been an incredible ride for those industries that are participating in the housing ecosystem. And I'd like to walk you through, first just an overview a little bit about what the demographic backdrop is currently, talk about the current state of sales in terms of new home resale and the outlook that we have, mortgage market, what we're seeing in building products, which is really a combination of home improvement, non-residential construction, as well as what's happening from a supply chain and cost analysis. And then we'll touch on multifamily rental and single-family rental, as well as the political change that we're seeing, or at least contemplated by this current administration under Biden. And then we'll finish with our macro forecast. So to begin, first I just want to look at the demographic picture that you see here. For looking at population and number of people on the left side of the slide, you can see that the number of 20 to 34-year-olds really peaked out in the early part of the prior decade in terms of rate of growth, and has been decelerating through the end of the decade, roughly through 19. And while we don't show you the forecast right now because the decennial survey was just completed, we'll be coming out with our forecast, but we had been contemplating further deceleration to actually year-over-year declines, but we're in the midst of adjusting those. On the 35 to 44 age cohort, what we're seeing is a continuation of accelerating number of people in that cohort. And that really bodes well for single-family construction, as young people that are in their mid to late 40s tend to be likely, cohabitating, getting married, and having children. We hope having children after they get married, but nevertheless, some don't nowadays. But that tends to mean you need more space. So we believe that lifestyle will dictate what type of shelter people will need, and it should generally means more space. Not necessarily they'll have to own it; they can rent it, but it is the catalyst, typically, family formation for a change of shelter. When we talk about the current state of sales, I would say that the market is too hot right now, and I think we need to have some moderation. I think to try to give you some perspective, one of my friends is a former Fed Dallas member, and she said, "Can you give me one slide that really depicts like the last several decades to try to say why you think it's too hot?" And what I'm showing you here is what we refer to as sales per community, or absorption rates. So builders like to say, if I sell one house a week, that is a level that allows me to see price appreciation, or 4 houses a month in a community. As you can see depicted in the slide, we, through the fourth quarter, we're at an all-time new peak for new home construction. And that has moderated a bit, but a lot of that moderation, at least through the early parts of 1Q, was really based on builders purposely limiting the sales that they actually are willing to release, because they had so much in their backlogs that they had to basically turn down buyers, and they were continuing and are continuing to step on the gas. But this just gives you some perspective where we are in the current pace of new home construction, new home sales, sorry. A lot of what I think is based on the demand factor. A lot of people look at the month's supply of inventory in the United States. Realtors like to say, as a rule of thumb, if you have a 6-month supply, then that's a balanced market. Anything above 6 months, you'll see deflation. Anything below 6 months, you'll see inflation. Well, that's a point in time, and it's predicated on current sales pace. So we like to look at inventories, all of single family, majority of course is existing home inventory, but new home inventory plus existing home inventory divided by the number of households. And what we're depicting here is that the level of that ratio is at an all-time record low. Interestingly, it was at a record low pre-COVID, and a lot of that had resulted in really a lack of what I'd call turnover, and some of it was predicated because of aging in place, lack of discretionary upgrades. People had refied and got into a situation where they were locked in at a low rate. But COVID changed that, and inventory fell further, call it another 25 to 30%. So inventories is as tight as it's ever been. But keep in mind, inventories can change quickly, and we do have 2.1 million homeowners today that aren't paying their mortgage. And when you think about what that would do if you were to do a dotted line, not assuming they're going to be foreclosed, because I don't think they will, because there's so much equity that we have homeowners have generated through home price appreciation, but we could see a lot of inventory come back to the market pretty quick that would put us above historic trend lines, assuming there is no longer from this administration the forbearance that's been afforded to those struggling borrowers. And understanding, I did yesterday what we call a spotlight call with an independent boutique that focuses on Washington policy, and they were saying that the government will not extend forbearance, so it will expire in September. And then the CFPB might give a sort of, I don't know the language exactly, but some type of oversight to mortgage servicers to make sure they check a bunch of boxes and they won't be able to foreclose through December. But this is something we need to think about because it will have an impact on inventory. And right now I'd say the inventory is greatly needed. But the only way to solve for the nation's inventory constraint is to build more homes, realistically, whether we're building more homes for rent or for sale. So the builders have been struggling to try to provide more supply. So if we look at starts, I'm just thinking about that 2020, we did get a nice pop in starts. It was up about 12%. This is single family. We are forecasting another increase of 16% this year. So just hovering below that 1.2 million. And in 2022, we think that, 21 is 16, 4% in 22. Part of the problem is that builders just don't have enough trade. They don't have enough people. It's a finite number of basically supply constraint issues, labor being one of them, that they can't build them any faster. And so people think, well, we should be doing 1.3 million, 1.4 million single family starts. Right now, if we could, we would. We just don't have the capacity. So I do think we'll see that starts will keep ramping, but let me continue. So this is one way to really reflect what I'm referring to. So when you look at starts divided by orders, historically, if a builder generates or writes a contract, they start the house. So it should be 1 for 1. You can see it back in 2013 when it's above 1 or 100, that implies that they're building spec. If it falls below, they're not keeping up with orders. And that's where we are right now. We're currently well below where we need to be. So we just published our proprietary builder survey that aggregates several hundred builders that equate to about roughly 20% of new home sales. And they basically are running now at 87% with their start growth. That was up about, I think, 40%. And that was from the prior month, they were up 80% year over year. So the numbers, while good, they've decelerated. And I think that you're seeing some builders, 40% of our private builders won't do a dirt sale right now. And they won't do a dirt sale because if they do, the consumer will lock in at, say, $400,000, and by the time it actually gets completed, it could cost an extra $100,000 because that's how crazy inflation is right now. So this is a challenge to get the product to market, but we are seeing orders starting to decline. Orders were down for our May survey about over 25% year over year, and that's a combination of tough comparisons as well as what we're saying about limiting sales. So Think about land. Land is the bloodline of every builder's business, and the land supply in the United States is very tight. So if you think about location, we refer to A location as the closest to the job center. B location, you're getting into suburban, less desirable. C, I like to joke, Ted, that it's kind of where the cows don't even want to live, you know? And so what we create with the land development survey that we do that aggregates about $15 billion in assets from land developers nationally on a scale of 0 to 100, 0 is no supply, 100 is plentiful, and 50 is normal. You can see that through the first quarter, even the C lots are constrained. And that's challenging builders, forcing them, and this great country of ours has always sprawled. When I remember when I moved to Northern Virginia in 1985, I told my friends in New York I was going to be moving to a place called Reston or Herndon, Virginia, and they were like, that's where the cowboys and Indians live. Like, where the hell is that? And that happens to be near Dulles Airport. And oh, by the way, that's an A location now. And so when you think about sprawl, it's a natural part of the country. But what we're seeing is that builders are willing to go the furthest out. They have no choice to go further out because that's where they can buy land. But even that land is inflating at a very rapid pace. If we look at the lot price inflation through 1Q, the land development survey showed that lot prices on a national basis were up 24%. Now, if you talk to builders and they're in a market like Phoenix, or they're in Sacramento, or they're in, I don't know, I'm trying to think of the big ones, in Salt Lake. I mean, there are Boise, there are lot prices up 50%. So it's very market specific. So this is a national figure. I'd say it's probably nationally through 2Q. It's probably even closer to 30% nationally. And you are seeing, like, one public builder CEO says, oh, we're not paying that much. We're driving way out. And their lot prices are only up 10%. So this is really an aggregation of all lot prices. But you do have less inflation the further out you go. But don't be fooled to thinking there isn't lot inflation. It's pretty significant.
Ivy, if I could ask you a question on that. Do you think banks are getting too far out and from a risk standpoint on financing the builders, where especially when they're going out and I see this quite a bit, where they're going out and buying lots that, you know, in a normal economic setting, they might not be buying that land. Do you see any of that, or do you even think it's a problem?
I think there are a lot of problems. So it's a function of the banks. Well, every bank has a different risk profile. And right now there's a massive amount of institutional capital. The prettiest girl to dance right now is build for rent. But what people don't appreciate is that build for rent is a single family development, just like for sale housing is. And they're actually sourcing it from the very same land sellers that the builders are trying to source for the for sale product. So we have numbers that have been thrown out that it's tens and tens of billions of dollars, close to $40-50 billion that, and every day, Ted, we get a new announcement that institutional capital is coming in. So depending on where the banks intersect, we do a survey, acquisition, development, construction lending survey quarterly, and the capital is plentiful. The terms are easing. It's more competitive. The LTV ratios are moving higher. Their terms are better because it's single family housing right now is the prettiest girl to dance. And arguably that's just bringing in floods of money. It's free money right now. So I don't know, I can't answer per se, but if I'm a bank and I'm looking at where my builders are operating, I would be very focused on how much capital they're willing to invest in those further out markets, and recognizing that, you know, some of that might be very opportunistic, and if they're with good customers that know what they're doing, but they have a lot of competitors that they need to understand the competitive landscape, because even if they're smart and their builder's smart, there's 3 other corners around from them in the same neighborhood that someone might be building a ton of product that they don't know about. So that's what we're trying to figure out. We're trying to figure out, where is all this supply coming? You know, I'll talk to hedge funds. It turns out that they have 5,000 homes in their portfolio that they have a single family rental, and that they're buying a third of incremental new lots that are builders are building. So they're buying directly from builders. So can't give you more. I'm sure we'll get into it a little bit more later, but let's continue. But yeah. So lot inflation, obviously we talked about. Now let's talk about the land grab. So the good news is that we can take the publicly traded companies that we analyze, which represents 42% of new home sales. Kind of funny because back when I started in 1992, it was 8%. So the publics have, really done a nice job consolidating the industry, but they have a business model that's flawed, and it's Wall Street's fault or their fault or everybody's fault. They have to keep buying more lots or controlling more lots, because if they don't, they can't generate revenue. Now the privates can say, I'm going to shrink because I don't like what I'm seeing out there, but the public's just foot on the gas, buying lots at inflated prices. And you can see here that the lots that they own and control at year over year through 1Q is up 23%. This doesn't include what the outside institutional capital might be doing for land grabbing for build for rent. So this concerns us, because even though a lot of this is via options or via land banking is expensive. So for builders, their margins can get hit because they're coming off of a lower base. The cost of capital that land bankers charge 15%. So their margins are already lower, but they like it because it juices up their ROE because they don't have to own the land on balance sheet. But there's still a 20% deposit. They got 15% cost of capital. They're going to have WIP in place. And if they get hit, they're going to have real risk that margins are going to compress and even pricing could come down. So just thinking through this land grab is a very important part of the analysis of our ecosystem. Community count, this just reflects that during COVID, the builders were selling so fast throughout all of COVID that they were seeing year over year declines in the number of communities they had open for sale. But because of the land grab and ability to bring new communities on to replace the ones that they've sold out, we should be seeing an inflection point starting just right around now and sitting in through 21. I think by the end of 21, we'll start to see in the fourth quarter an inflection. And some of the publics are already saying they could be up 10%. So this is national based on public builder count. And when they bring more communities on, the good news is that maybe they won't step on the gas like they're driving in a race, at 80 miles, 100 miles an hour, continuing to raise prices at a double-digit pace. In fact, our May survey showed that home prices were up an annualized 14% for the 12th straight month, double-digit price inflation. So let's talk about the mortgage market. I think this is where, people are pretty complacent about rates, and fear of rates rising is not as well understood as I think, or the risks of even a modest rate increase. So back in 2018, we all recall that mortgage rates went to 5% and the housing market stopped. And everybody was like, how in the world can 5% mortgage rates stop the housing market? And you and I, Ted, are old enough to remember when mortgage rates were double digits in the early 80s. I remember my dad bought 2 houses because my mother didn't like the first house and we were moving back from Europe. Anyway, my poor dad. But in talking through, a 5% mortgage rate, like what in the world happened? Well, what in the world happened is that many consumers, thanks to a refi boom, were locked in well below 5%. And this shows you 77% have a rate currently below 5%. But these numbers are going up every day. Now, I don't know if people live under a rock that don't have a mortgage rate above 5% right now, or they just have really bad credit, or they just don't understand what's happening in the economy. But 49% of consumers currently have a rate below 4%. So think about it, Ted. I don't know if one of your family members or friends, they're locked in at, hopefully for them, the trough of 2.6, or they're locked in at 3 or 3.25. What the Fed hasn't really banked on is the fact that this is going to reduce mobility substantially. It's not that people can't afford, they're just not going to give up that low rate, not to mention when they sell their home, even if they have a lot of equity that they've fortunately created through their home price inflation, the house they have to buy is going to be highly inflated. So many people just won't move. And that will bode well for repair and remodel, but it's going to hurt the overall housing market, I think, even at 3 3/4 at 30-year fixed. So as we look at the 10-year yield and moving forward, the one thing I would say is interesting. So we like indexes. So this index 100, think of it at normal affordability. This is for a first-time buyer entry-level index. Anything below 100 is favorable. Anything above is stretched. So notice even through our forecast, which incorporates what the yield curve, the blue chip economic indicator, is forecasting for mortgage rates, as well as our forecast for home price appreciation. So this index is really a monthly payment as a percent of gross income. The monthly payment would be interest and mortgage insurance. So even in 18, notice in 18 that it was still favorable. Even though it was favorable, it got less favorable and the market still slowed. And when you talk to builders in 2018, you'd say, so is it just because people don't want to give up their rate that you're seeing sales slow? And they'll say, no, the monthly payment went up. So for every 25 basis point increase in the 30-year fixed mortgage rate, that's like an equivalent of a 3% increase in the monthly payment to the consumer. So basically the monthly payment went up 10% in 18. And as a result of that, not only did it disincentivize people to buy because they were locked in at a low rate, but it did hurt affordability. So what we have right now, Ted, is a very different picture because there's a lot more than primary buyers in the market today. We have a lot of investors that are in the market today. And we can categorize those investors as second home investors. They could be fix and flip investors. They can be build for rent, single family rental, iBuyers. You've got pure investors that are just taking advantage, like in your great state of Texas, in Austin. I got a builder calling me. He goes, Ivy, we went right out from being giddy to terrified. And now we've got home prices up 25%, and our sales guys are telling us, like, holy crap, there are people buying houses sight unseen. I don't know what they're doing with these houses. I don't know if they're going to try to sell them when the market starts to correct, but I'm scared. So that's what we're hearing from builders, and not little builders, big builders, okay, that are seeing lots of scary things.
Ivy, let me ask you, do you ever factor in, not all states, but there's probably a third of the states maybe have maybe 2% real estate taxes, ad valorem. Do you ever factor that into the affordability side too? Because if you go up a lot, obviously the payment stays the same, but the taxes are really going up.
Yeah, I think that I don't know that we've done an analysis per se that taxes itself with home price inflation are going to be a game changer. Remember when SALT came to fruition and everybody could only deduct property taxes up to $10,000? Everyone said, well, the Northeast is going to get killed and everybody's going to leave the high cost tax states. And frankly, it's already been happening anyway. So if you look at from 2010 to 2020 and look at the states that had the highest household growth, Texas, Utah, Florida, all the red states grew at 2 to 3 times the nation in households. So the Great American Shuffle has already been underway. And your state's a big beneficiary of that. Florida's a big beneficiary, but it's predominantly is it due to taxes or is it due to affordability? And right now I'd say that the perception is that COVID has created this Great American Shuffle. It had already been well underway. And SALT didn't start it and COVID didn't start it. So it's a factor. And think about this, like I have some billionaire hedge fund buddies, working on Wall Street for 30 years. These guys are all moving to Miami. I got guys that are living in Newport Beach, moving to Miami, moving to Nevada. They're all getting out. So in their minds, there's just droves, millions of people are leaving. And guess what? Look at the state of California, and we look at postal office data. So we can tell you change of address, who filed for a change of address in the state of California. It was 0.3% left the state. So we're talking about 70,000 households, and the world thinks it's millions. It's not. So I think it's happening, but not to the magnitude that people think it is. But it still is skewing. Red states are bigger beneficiaries, and frankly have better governors running their states because they are not going to continue with unemployment benefits, the excesses that are disincentivizing workers. But anyway, I'll get off my soapbox. So let's continue on building products. So I wanted to show you that it's not just a new home market that's benefiting from, free money and the housing that had taken center stage. What we're seeing in home improvement, which we survey roughly 150 billion in aggregated revenue of manufacturers and distributors and retailers. So year over year, April, you can see we didn't publish building product survey yet, it comes out next week, it was up 42%. Seeing a lot of discretionary money going into people's homes. The age of the U.S. housing stock is 45 years old, with some of the markets east of the Mississippi well above 45, and those west of the Mississippi well below. Nevertheless, homes get to a point where 15, 20 years old, they need a facelift, and a lot of people didn't do those facelifts during the Great Recession, so there's pent-up demand, and home improvement is hot right now. Problem though, it's so hot, the costs are out of control. The costs, everything across the board is inflating. And whether we're talking labor, transportation, materials, if you're sourcing from Asia, if you're sourcing domestically, we're talking massive inflation. I'm telling you, like, wallboard's up 40%, stacked on stacked on stacked. Flooring up 15%. Phoenix framers up 20%. Maybe the most modest inflation I've heard is 5% coming from faucets, but we all know lumber. But the market is just terrifying if you're a builder doing a dirt sale. You do not know what your costs are going to be, and you barely get product. Everybody's just hoarding product right now. Anything they can get their hands on. I mean, I heard somebody bragging that as a distributor that's paying $16,000 for containers from Asia when they probably cost normally $2,000 and they're currently probably priced between $5,000 to $6,000. And I said, why the hell is this guy bragging? There's like one guy telling about another guy. And he says, because he's saying, I'm serving my customer. I'm doing everything I can. So I said, well, I hope he has any money left after, he pays $16,000 for a container. So this report's coming again from our building product survey. 94% of our survey respondents said that their lead times are well above average. So this is just a list. So if we just pick first one, fasteners. Normally takes you 4 months to get fasteners. Now it's 7 months. Tools, 6 to 8 months. Normally 3 to 4. The lead times are killing builders trying to get their backlog converted. And it's not just builders, it's our home improvement industry, it's our non-res industry, it's our multifamily industry. Everything in the ecosystem is constrained. So let's wrap up with a quick overview of multifamily and single-family rental, and then we'll give you our forecast, a little bit about the administration and some of the things there, and then we can go, if you'd like, to more questions, Ted. So multifamily, on the left-hand side, we're just showing you strictly rent growth. And rent growth for across the nation, includes suburban and urban, is running, call it, probably at a fairly healthy clip off the bottom, close to, in 2021, we're seeing 1.1, but it's going to be higher than that. Some of that's predicated on at least what we're seeing real time from our surveys right now, and it's definitely better than 1.1 so our numbers are going to go higher. The revenue growth side of the equation is a little bit higher because that actually takes occupancy into consideration. So it's occupancy times rent to give you revenue. So we're seeing very healthy occupancy. If we look though at backlog, so people don't recognize that backlog pre-COVID for multifamily was at nearly a multi-decade high. These are units that have been started but have yet to be completed. And most of this is in the urban cores where people are not working anymore because they're working from home. So there's a lot of pressure yet to come, but it's been kind of like, remember the pig and the python with foreclosures given the judicial states? It's just really slow, and part of that is because development is so constrained. But nevertheless, that's a hangover, but it's more urban, and right now suburban is hot. And there is a wall of capital continuing to invest in multifamily, and that's really predicated because multifamily might be the tallest midget in commercial real estate. So multifamily still has a lot of demand, and cap rates continue to compress, and you're like hearing cap rates at 3% on existing product or anything on development, 5% cap rates, and normally they're 6 to 7 cap rates. So we're really struggling because we think NOI is under pressure, but returns are increasing because there's such a strong demand. So for single family rental, I would just say similar to rent growth on the left, forecast for this year at 2021, is 5%. Certainly that being driven or mitigated by renewals being a little less, being more tepid. But new move-in, I'm kind of shocked to hear some of these single family rental operators like Imitation Homes and American Home for Rent that are bragging that they're raising rents 14, 17% on new move-in. And it's like, I guess everyone's using stimulus. I don't know where consumers are getting that kind of ability to meet that type of rent inflation. On the right-hand side, again, incorporates occupancy. Occupancy right now for single-family rental is running at 98%, highest occupancy on record. This is another one of our independent proprietary single-family rental surveys. And I would tell you that some of that's artificial because there's a lot of renters that aren't paying, but you can't evict them. So there's some of the occupancy is artificial, and we do have pressure on collections. So it's the same thing in multifamily, by the way. So occupancy in multifamily is being artificially inflated because you have tenants you can't kick out. Although now, depending on the state you're in, the federal government says you can evict, but some states say you can't still. So it's a little bit of a mixed bag. So just to wrap up on the build for rent, I think I hit on it quite a few times. The idea of it, I'm bullish on build for rent. I think it's a good thing to have for the industry flexibility to provide consumers that don't have the ability to own, to give them that space. They have bad credit, they have too high debt to income ratios, or frankly, they just don't have enough wealth to come up with down payment. But right now, the wall of capital coming in is at such a ferocious level, and we can't quantify it because it's all concentrated, but it's doubling. So I'll talk to a private builder and I'll say, so how much of your sales in entry level in the 300,000 have you sold directly to build to rent operators? And they'll say, I don't know, about a third. I'm like, a third of your sales? Well, they'll come in, Ivy, and pay a huge premium. So then I get a deal in Atlanta that made the front page of the Atlanta Business Journal, Atlanta Chronicle, whatever it's called. Clayton County had a deal that a municipality approved for 224 sale homes, and it was affordable. And American Home for Rent came in and bought it at a massive premium, and guess what? They're now all rental. Well, Clayton County's not happy about it, so they put a ban on further development. And then a second deal happened, similar. And then one other story, just to give you an idea, in Dallas, one of my builders who is building in, really just Dallas, he said, I've seen 2 broken land deals already for build for rent guys that paid so much up for the land, but now they're dealing with such rapid inflation for construction costs, they'll never get the lease rates they needed. Now they're trying to sell it. And by the way, these guys, the cash coming in, the amount of cash purchases, it's got leverage behind it. Who's providing the leverage? But they're levered up, a lot of these funds. Now they get some equity capital. So a lot of stuff in here, Ted, that worries me. I'm paid to worry. That's what I do for a living. And I may not be the most popular person right now, but that's the reality. We've got some challenges with the market that's got the foot on their gas, and they're driving around dangerous curves that might be going a little too fast, way over the speed limit, down a curvy road, maybe 80, 90 miles an hour, and that's the build for rent guys. That's the institutional capital coming in. So the Biden administration has got some plans to put some gasoline on our fire. They're going to pour more demand into the market by providing first-time buyers a tax credit. And whether that tax credit comes to fruition, $25,000 for down payment, but it's very narrowly focused, first generation only. So if you're a second generation first-time buyer, you don't get it. So it's basically legal immigrants that have entered the country first generation. Dreamers, those are the 800,000 people that actually have access to FHA financing now that are born by, a parent that was an illegal immigrant, but they're born in this country. FHA insurance premiums, I'm being told they will reduce premiums, again, creating more affordability. We've heard about student loan forgiveness plans. We've heard about rent credits, attempting to easing of zoning. That sounds great to me because guess what? Even in your great state, there's a lot of pushback from local residents to their legislators that, not in my backyard, I don't want that affordable housing. I don't think the federal government's going to get that done, but it would be nice in theory. So a lot of things on the Biden's administration's proposal or their plate that they're contemplating, frankly, I don't think they get anything done. That's just my being a cynical person. So, and I have a lot of thoughts about it, but we'll leave that if you would like in Q&A. So just to wrap up, our forecast, by the way, we do a quarterly macro forecast for each of our silos. So we have one for new construction, one for home improvement, and we have very detailed reports on each sector, and we'll be publishing next week, and we'll be revising our numbers and tweaking some numbers. On the on the production new home orders, I say production because it excludes custom. So we're looking at one piece of the single family market, the majority of which we analyze. We really don't have a lot of custom builders that we're dealing onesie twosies. But you can see that orders in 2021, we're forecasting a 7% increase. That's really a tale of two halves, right? So you've got this massive January through really April where you're running up like 40, 50, 70, 80% because you're on easy comps. And the second half, you're now down 25 and you're going to get worse and worse. Combination of tough comparisons. We are hearing from builders that they are starting to see some moderation in true demand. So if they were selling 7 homes a month, now they're selling 5 a month, and they think it's because of affordability or sticker shock. And don't forget that many of these builders that are limiting sales is also a factor. If they're not willing to start a dirt sale. I heard D.R. Horton that did dirt sales, and by the way, D.R. Horton, only about 25% of their sales are dirt sales. But they are now anecdotally hearing that they'll pay you $15,000 to go away because they don't want to complete that house. They want to sell it after all the costs are incurred. So we do think that in 22, we're going to see orders moderate. We're also concerned across the board that just demand is going to moderate as housing is no longer at center stage. But we do think home prices in the bottom right corner, notice that we do see home price appreciation continuing. I think you could see corrections in certain cities, certain parts of the country where home prices are just at an inflated level and demand is more speculative. But you can see at our start forecast that for 2021, that 16% increase, again, it would be higher in 2022, but it's of the supply constraints and this terrified, I don't want to just start houses or write contracts without having better control on the cost side. So I think this hopefully, just to keep in mind, we are in the midst of the revising the forecast, but hopefully this will help you. Here's our forecast for both home improvement, multifamily, and mortgage origination. So maybe I could stop there, Ted. I think I've gone, I don't know, maybe too long, but hopefully still interesting, and turn it back to you.
Ivy, not too long. I'm sure people that are watching this that are probably interested in taking your service too. They could probably listen to you for 2 or 3 hours. But what I was going to ask you, if you looked at home price appreciation over the last 12 months, and I know you had it on your numbers here, and home improvement spending and that sort of thing. So what do you think happens, and this is just curious, what do you think happens to, there's two questions. One, what do you think happens to residential buyers that are acting sort of out of bounds in terms of going to see a home and saying, hey, we'll bid you 25% over anybody else that's asking, cash price, walk away? And the second question is, what do you think about the multifamily people that are going in and buying these, and I've seen it too, where they're going in to buy these apartment complexes and they're buying, they're going down and buying B and C rated and trying to play that game, and I'm wondering where all of that ends up too. Sort of a two-part question.
I think that we never know exactly when the music stops or what's going to make the music stop, but I think that the way I would say it is that thanks to the Federal Reserve, that's the bartender at the raging party, and everybody's just, drinking up enough cocktails to be having a great old time. And I think that a lot of that is just free money. And so when people have access to money that's, generally almost free, you start to see that the Fed has to taper. If they taper mortgage-backed securities, which they're saying and they're signaling they're going to, and you start to see spreads widening and the costs are higher, you're going to see less speculation, less people that are willing, their cost of capital is going to go up. So I think that a lot of those guys are going to get in trouble. People are going to get in trouble depending on their balance sheets, depending on how much equity they have in the game, and their staying power. Everybody's long-term investors. Everybody's a long-term investor. And till all of a sudden their investors saying, what the hell is going on? Because right now they're getting yelled at. The guys that are doing the B and C, they're being told, you raised a fund. Why aren't you allocated? Why are you sitting in cash? I'm okay with a levered 5% return. It's better than nothing. So there is just this, it's just so circular. It's just crazy. And so I think that there's risk in the market that is just increasing. And we could be early. We could be early by a year. I don't know how long it will last. I think the party's somewhat contingent on what the Fed will do, what the administration will do. Will the administration keep kicking the can down the road? I mean, I was in Houston, in the great Galleria of Houston. My father lives in Houston, and I was there, and I was shocked. I was walking around on a Thursday afternoon at 2 or 3 in the afternoon, and the place is jam-packed. I'm like, why aren't these people at work? And I just don't understand how this administration keeps incentivizing people not to work. So a lot of the things that are the biggest risk to our housing market is the stock market. Stock market is creating massive wealth, creating a massive, divergence of equality, and it's just free money. Free money stops, stock market goes down, all of a sudden people don't feel so rich, they don't buy as much. So it's all tied together, Ted.
Ivy, on that message, we've always had a graph on the market, and we show housing with it. We correlate them on the same graph, and while they're not exactly perfect, they are really, really close. So if the market breaks, housing breaks, and so it's kind of interesting to see. But I want to thank you. I can tell you your information is so far above everybody else's. And I want to say this to everybody out there. There's a stream here you'll see 4 or 5 times during this, obviously. And I would encourage you to contact Ivy's company, Zelman Associates, and I think you'll find that there's a lot there you could use if you're trying to decide what you want to do the next 1 or 2 or 3 years. And Ivy, I want to thank you. I know you're busy and you don't take the time a lot of times, but we appreciate you doing this for us.
Well, Ted, thank you. And I would just tell you, I'm very happy to say I'm back in New York City for the first time since March 6th of 2020. And the Big Apple's doing better, and we're healing. We just need to get our administration and our Federal Reserve to start actually pulling back on the medicine and let us heal.
Well, thank you very much, and we look forward to seeing you again, Ivy.
Thanks, Ted. Take care.
You bet.